Hey there, everybody. It's Bob from Trade Genius. Got my good friend Phil here. Is the bond market ready to blow the entire United States economy apart? Stay tuned.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening. Okay, Phil, we've had a bit of a bond bloodbath here the last 3 or 4 days.
Yep.
We have Rick Santelli telling everybody we have 13% 10-year rates coming. We have Jamie Dimon says we're going to have 7% Fed funds rate. But we're seeing something really anomalous in the market that tells us maybe not yet. Do you want to explain that to everybody?
Yeah, and it really comes down to institutional volume that comes in. And so what we can do is take a look at a couple of charts here. What was interesting to me is we were taking a look at institutional size volume that comes in. And so here's a chart of the last couple of days on various things, and they're all bond ETFs. So if you look, this is a junk bond ETF by Barclays. It's SJNK. You'll notice there's a couple of those diamonds in the lower right corner. Those represent extremely large trade sizes, hundreds of millions of dollars. They're coming in at the bottom of this move here, and typically that's what you see in either a institutional short covering situation, or they're coming in to buy a certain level. So you see it here on SJNK. Here's another one. This one is the 5-year target duration TIPS index fund by FlexShares. The symbol on that is TDFT. 9th largest trade executed in its history, and it's executing down here at similar levels on TDFT. We can look at another one, Bob. This is the iShares U.S. Treasury Bond ETF, GOVT, government. And again, a series of institutional orders come in at the bottom of a move. All right, so that's another heads up. And then another one we saw today too was Vanguard Long-Term Corporate Bond ETF, VCLT. And you can see there was a high-ranking trade on October 2nd, and it dropped down into another high-ranking trade here today. That could be short covering, but the point is that either they're short covering or they're initiating positions. Either way tends to put the brakes on these types of move. And like you said, we were talking today, the hysteria around the bond market blowing up is getting high. I think you mentioned Rick Santelli was on CNBC yesterday talking about 13% rates, right? So, and usually CNBC, when they start talking about stuff like that, they almost pinpoint bottoms in markets within a day, it seems like. So I think there's evidence here that the institutions are putting in positions or doing some positioning around these levels, these much highly oversold levels, I might add, in the bond markets here.
Yeah, and I have a couple points to make too. First of all, the circles and the triangles that you see, or the diamonds you see, are massively anomalous trade by volume, and so they get recorded. We have a service that kind of alerts us to these things because we know that big money can't move unless it makes liquidity for itself, and that's what it's been doing with this selling. And usually when you get the news narrative to follow it, it's kind of at the end of its game here. The other thing I want to say, Phil, is that ES broke through its 144 last week, and that's a good place to go long. And just for people saying, well, why are you going long, Bob? This market looks like crap. Well, you go long at the 144 because that's a high probability trade. If you're traders, you trade in probabilities. You just don't trade necessarily looking at the wiggles. And then today we broke the 233 moving average. These are huge, huge reversal areas. Right. And now we're starting to get sprinkled with these massive volume bombs, meaning that big money is moving into these trades here. The other thing too that really struck me, and I wasn't hurt so much today as I could have been, is that I'm leaning long on SPY, and I'm long oil, I'm long gold miners, I'm long silver miners, and they were all up today. So it's just kind of worth it. And Bitcoin, we talked about Bitcoin yesterday. Bitcoin was like okay, I just had a 6% move. I can get back 1/3 of 1% today. So to me, this seems like it's like liquidity positioning, getting ready for a reversal fill. And you were talking in the room today too, and I think it's important for people to know when we start hitting these 50 weeks, these 233, 144s. When you get these reversals, they're not just couple point reversals, are they?
No, in fact, when you get to the 50-week moving average, which we did today on ES, they will typically scare the children by going under it a little bit, like we saw today. Then we saw some short covering at the end of the day, but that's how they tend to bottom these markets. And so that level, if you guys are curious on the ES, which is the futures for S&P 500, the 50 weekly is 4272. And so what we're looking for is that to kind of provide support. Now, hitting that level and bouncing historically, we'll see a little chop action around it. So we could be consolidating here over the next 24 hours. But if we do that, watch for that range to break out to the upside. That can spark off a 200 to 300 point bounce. That's in these markets with these ranges that we've been getting, the volatility that we have, and where we're trading with the S&P 500, that is a pretty normal expected bounce. And Bob, in terms of like where we're going to go with that bounce, you have the weekly 9 that's above us. You have the 20-day SMA on the index above us. Those are usually targets that will catch a bounce and then reject. I don't think we should be bullish. I think we should enjoy the bounce, but I think you have to sell those into those big technical levels above. I think you have to sell them. And if we start deteriorating more, one measure I like is when the weekly 9 EMA crosses down through the 50 weekly SMA. To me, that is bear market is back on. We got a reprieve from that earlier in the year when those moving averages crossed up bullishly, but now we're threatening a cross down bearishly. And at that point, in my rule book, it's bear market on.
Yeah, and a couple other points too. So in March we wasn't in March, it was in 2022. We actually had a March. We had a 7-week straight red. So the most we've had since then was 5 weeks straight. We're 5 weeks right now. That's the other thing too. A lot of people now are saying, should we close this? Should we short? Should we do this? Should we do that? At this point, your risk return is better off just staying put. If oil was going down, Phil, with the bonds and with the market and the dollar going up, then I would say it's more of a risk off here. I think this is more of a, positioning move. Remember, seasonality, March and September are the 2 worst months for volatility. And now we got VIX over 20 again. And look, worst case scenario, VIX goes to 30. And then you got the easiest trade in the world then. Just short VIX out 90 days, close your computer, and just collect the money afterwards, because only 4% of the time does the VIX remain above 30. Yeah. Okay. Very, very rarely does VIX remain above 20. So, these moves tend to be violent when it goes from 20 to 30. So if we're in that mode, then we have 2 more weeks of pain in front of us. But I personally think that the volatility guys are talking about a turn on the 6th that may get front run by a day or two. Well, today's the 3rd. So I'm still looking for a relief bounce fill into resistance, and then potentially even a lower low from here, maybe down to 404 on SPY. And then I think we're done for the year. And then I think we're going to get Santa. It's going to come early and take us all the way into January before we get our next market down move. That's my view. We're going to trade what's in front of us. We'll be putting out the training video on the new indicator too. Hopefully we're going to get that recorded as well today. And then for those who are customers of ours, you'll get to see it. And then you don't have to really guess. You don't have to FOMO. This indicator will tell you, give you some guidelines as for reversal. So, but that's kind of where we are right now. We're blowing out of all the channels. We're blowing out of all the moving averages. The big money is making liquidity for itself. We're starting to see bigger buys in these zones here. And so I smell reversal.
One thing I'd like to show you guys too, why you don't want to short this market here real quickly before we go. We got a big high volume node here. This is a volume profile here on the right-hand side of this chart with this histogram that's sideways. And you'll see we have this big volume node right around 42.26. This area on this is ES. Actually, I take that back. 42.40. We got, in terms of the move, we got really close to that level today. Maybe 8 or 10 points above it. But The point being is that when you get into a big volume node like this, you're probably going to find support, at least in the short term. Now, I think this market's hosed. Don't get me wrong. I think the market's really hosed. But these aren't formations that you want to be engaging and putting new shorts on into. Rather, wait for like a sympathy bounce and you can short higher up here. Then the next try down here, they might start breaking through that. But on the first attempt on a high volume node, not the greatest spot in the world to do that. The other thing too, like Bob was mentioning, we have the 50-day moving average, or the weekly 50 SMA, moving average here, which we've bounced into. And, if you look back on the chart, and if I zoom way out, just to give you guys some reference of what we're talking about, first of all, coming down into that moving average, right? So this head and shoulders that we were all looking at finally played out into that. That's a logical destination, by the way. That or the 200. So we got the 50. Things are really oversold here. It's rare for you to see the SPX pull back down into its weekly 50 SMA. It just doesn't happen a lot in the market. Where we saw the last time it came down for the first time, what I call the first touch, was at the top, coming off the top of the market, right? The all-time highs. And you can see this is a 4-hour chart with the 50 weekly overlaid on it. You see how we bounced into it? Looks scary, right? Like we're going to fall off a cliff and break down below it. Nope. And what do? Rip back up. This big step line is the weekly 9, okay? This smaller one's the daily, all right? So these are the kind of ripper rallies. They make it look really confusing, really choppy, and then they'll rip it up on you, right? And everything will rip up here. Crypto, everything. It'll be risk on. Metals too. So that's why you don't really want to short here. Where you do short here would be a situation like this where you do get a breakdown, it comes up from below, then you want to short that. You see how you get that reaction back down. Whether or not we give it all up here or not is another discussion, but that's how you want to treat these levels. The other thing that I wanted to point out is this chart. This is a chart of our breadth. This is shorter term breadth over here, longer term breadth over here, but both of them are at extremely depressed levels. In fact, on this side over here on the right, okay, this is the short term, this is the longer term. This is getting to levels now where these green bands are almost an immediate reversal. Okay, we don't have today's print in yet because these take time to update end of day. But you can notice the last couple times we got into this green zone here was back in August. We had a nice ripper bounce up there. The previous time before that was March, ripper, and that March was the low. I mean, we just ripped from there. And then also before that was December of last year. I could go back and show you more readings, but you get the point. Is that these are depressed levels for Brett, and this is where you get these big ripper rallies out of it. So you never want to short into these. You want to be covering your shorts into this is what you do. You don't want to be shorting here. So the point of this video, you're hearing a lot about the bond market blowing up. Does it look good for the bond market? Absolutely not. Bond market looks terrible, but I think you're starting to see institutional volume come in where they typically will buy a bounce, and you're also getting market breadth readings that historically tell you that we also are probably due for a bounce, even though it looks like we're going to fall off a cliff here. So just know the games that are being played and what you hear out there on the media and on the headlines and in Twitter. It's the end of the world, but in reality, we're probably due for a bounce here. And ultimately, I do think we roll over for new lows, but don't initiate it here. Just probability wise, it doesn't make any sense to me. So I just want to share that with the folks there, Bob.
I think it's going to be a pretty wild couple of weeks, and hopefully we'll give you guys some good info. Hit like, hit subscribe, come check out our channel, come check out our service, and tell your friends about us. And with that, have a great day, guys. Bye-bye.
See you.
Trade Genius.